Hey, what's up guys? It's Andrew Winnett with the Legacy Movement, and today we're going to be going over the pros and cons of the three different types of term products. Okay, so the first term product that we're going to look at today is the fully underwritten term. Now we're going to explore the pros before we get into the cons. Now, fully underwritten is pretty straightforward. It's something that really you can get a lot more bang for your buck if you're super healthy, you've got no pre-existing conditions, you haven't had any health scares. So the pros for fully underwritten are actually pretty straightforward. They're pretty simple, and there's only two of them that I can think of personally. And that's number one, it's a lower cost. You can get a cheaper, this is potentially the cheapest term product you can get. But I've noticed what I put over here, if you're healthy, okay? The reason why it's cheaper, okay, is because, and we'll get into this in a moment in the cons, is the insurance carrier is gonna do a deep dive into your health. They're gonna do a blood test, they're gonna do a paramedical exam, they're gonna have a nurse come over, they're gonna check your blood pressure, they're gonna make you pee in a cup. If you've been to the doctor, they're gonna look at all the doctor's records, all the attending physician statements. It's pretty intense. So if you're healthy, you can get a lot more bang for your buck. And that's why I say that number one, the first pro of fully underwritten term is actually a lower cost if you're healthy. Number two, you could get more death benefit. This product allows you to basically get unlimited. There's no cap on death benefit. Again, though, it's if you're healthy. So that's the one caveat. Because the insurance carriers are going to be giving you more death benefit for cheaper, they want to know that you're not going to die or get sick anytime soon. And so potentially the second pro for fully underwritten is that you could get more death benefit. Okay, so now that we've talked about the pros, let's talk about the cons of fully underwritten. Well, number one, you technically can be declined. So, and I've had this happen where I have a client who wants to get fully underwritten. We go through the process, we get the paramedical exam, we go through all the paperwork, and a couple months down the road, it ends up being declined, which is a major bummer. The problem with that is that can hurt future applications. So for example, when you apply for an insurance policy, especially if it's a term, one of the questions that almost every insurance carrier asks is, have you applied for insurance in the last 6 months, in the last year, in the last 2 years? And then the next question is, what was the end result of that application? Now here's the thing with insurance, you have to tell the truth, right? Because if you pass away during the first 2 years, right, of that policy being in force, and you pass away in the 2-year incontestability period, the insurance carrier is going to dig deep and see if there was any fibbing going on, any lying on the application. So it's really important you tell the truth. Well, if you go and apply for a fully underwritten product and you get declined, it can hurt future applications. So if I go to, let's say, Mutual of Omaha and I apply and I get declined, but then I want to go to, say, a Nationwide, for example, Nationwide is going to ask, well, what happened with Mutual of Omaha? And you have to tell the truth, because you want, the whole reason why we're buying insurance is we want there to be a payout. So it can hurt future apps. I've had where the second company that we apply for, because we told the truth, they decline it altogether. And so you have to be careful. Fully underwritten does have some cons that you have to be aware of before you're applying. If it's one of those things where you're teetering on the brink of, I don't know if it's going to get issued or not, it's more often, it's better to go with a simplified issue product where you can get something, and then once you've had it for 2 years, then apply for a fully underwritten. So keep that in mind. Number one, the cons, it could be declined, and it does hurt future applications if you get declined. Number two, it could end up being more expensive. So fully underwritten products have a lot of different, they call it table ratings. So for example, let's say, going back to that Mutual of Omaha example, they may have 16 table ratings. So if, let's say, you have diabetes, well, that's 3 or 4 table ratings, right? Then you maybe had, you went to the emergency room because you thought you had COPD. Well, that's 5 more table ratings. So you may get approved at a table 9, right, if you would, but it may end up being more expensive. They'll make you an offer, but it's going to be more expensive than if you were to just do simplified issue. So you could end up being more expensive with fully underwritten as they dig deeper. So you need to factor that in as well. Number 3, it definitely takes longer to be approved. So I've had some that have taken almost a year to be approved. Very often 6 months. Fully underwritten is not quick. And so you need to factor that in if you're wanting to get something on your loved ones quickly. You need to factor that in. Number 4, you rarely have the option to get your money back with fully underwritten. It's more of a you go your way, the company goes theirs at the end of the term period, okay? And by the way, terms can be anywhere between 10, 15, 20, 25, and 30 years typically. There are some variations, but that's typical. Number 5, you do have to do paramedical exams. So typically you will go to a place that is preset for you, or the paramedical examiner will come out to your house. You've got to fast for it. You can't be, throwing up once they're doing your blood test, right? Because you feel a little queasy because you had those 4 muffins this morning, right? So you have to fast. It takes about an hour. In fact, the first time I got my paramedical exam, because I own a lot of different products, but I do own fully underwritten, and I got it, I think, when I was like 20, so I was like in really good shape. But I ended up passing out because the lady, anyway, I'm just not really good with needles. So there's needles involved and things like that, and it can be a little bit of an inconvenience. It was a bigger inconvenience for me because I was totally out of it for the rest of the day. You do have to do paramedical exams a lot. For some people, it's not a big deal. For sissies like me, it is. Number 6, there is definitely a lot more paperwork involved, and there's what's called APS, or attending physician statements. So that's very common, where the insurance carrier will be requesting information from the doctor, and so maybe you went and saw Joe Schmo 4 years ago, and then you went to your cardiologist and saw Jim Carrey, right? And that was 7 years ago. Well, they want everything from everybody you've ever seen. So it can take a long time. So those are the cons of fully underwritten. Now let's go to our second product, which I'm a big fan of, and that is simplified issue term. Okay, so now we're talking about simplified issue term pros, okay? And by the way, simplified issue term is a really, really good option for probably 75% of anybody who's 50 or below. Unless you're like 20 years old, you're, playing college football or something, you've never been to the hospital a day in your life, and you don't care about the fast approval process or convenience, simplified issue is pretty much going to be the best bet for most folks. The convenience of it, the fast approval rating, it just makes a lot of sense for a lot of families, especially with mortgage protection. If you've ever looked into mortgage protection, which pays off your house if you were to pass away, simplified issue is like 95% what you would use most of the time. I'm a big fan. I own simplified issue products, and I'm a big fan. So let's go over some of the pros. So number 1, there's a lot more lenient underwriting if there's any health concerns. So when I'm talking to a client, and again, through our companies, we've helped over 5,000 clients. So I've done this a few times. But if I'm talking to somebody and I'm picking up on they have even diabetes, for example, or it's pre-diabetic, right? Fully underwritten is not going to be the way to go, because if they do a blood test and their A1C, their blood sugar, if you would, is through the roof, well, guess what? We may just get a decline and they may not be able to get anything, right? So I'm a big fan of doing simplified issue if there's any sort of health concerns, because the underwriting is more lenient, okay? Number 2, there's fast approval. A lot of times you can get approved within a week. I mean, it's very, very quick, which is awesome. There's no paramedical exams, no needles, thank you God, right? You're not having to pass out like I did. Nobody coming to your house, you're not having to fast and prepare for that. A lot of times, simplified issue products have what's called living benefits. So for example, there may be a terminal, a critical, and a chronic illness rider, depending upon the state. Some states don't have this, but most of them do. But like for example, here in Tennessee where I live, there is a terminal, critical, and a chronic illness rider included in most of the simplified issue term products that I carry, okay? So for example, let's say you have a $300,000 term product and you get bad news that you've got cancer, you're gonna pass away within a year. That's a terminal illness. With most carriers, you'd be able to accelerate a majority of that death benefit while you're alive. Well, what if you have a heart attack, stroke, or cancer and you recover? Same thing. You can take a chunk of that money while you're alive, and if and when you do pass away, your loved ones get the remainder in many circumstances, many situations. Then there's also the chronic illness rider. This is typically what people would use for long-term care. It's anything where you can't perform 2 out of the 6 assisted daily living activities: eating, bathing, dressing, toileting, transferring, etc. There's 6 of them you can Google. But if you can't perform 2 out of the 6, that's considered a chronic illness, which is what we have long-term care insurance for. Long-term care insurance is very expensive. This would be more of a supplement because you could take part of that $300,000 if you have a chronic illness rider, and you can use it while you're alive to pay for whatever health expenses you're going to have, okay? So that's a nice benefit that really does come in handy sometimes if you get bad news and you get sick. And then number 5, you do have the option of getting your money back, which we'll talk about in a moment. But that is a big deal. I'm a big fan of simplified issue term. Most of my clients request this, and it's just the convenience of it. It is pretty amazing. So let's go over to the cons. Okay, let's talk about the cons of simplified issue term products. So number 1, a con could be that it could potentially be a little bit more expensive than fully underwritten. Why? Well, the insurance carrier is not doing as deep of a dive into your health history, right? They're not digging as much. So they're going to have to, increase the rates a little bit to cover for their risk, right? So it could be a little bit more expensive than fully underwritten. It's not too bad, honestly. In certain circumstances, the juice is worth the squeeze. If you would to do the fully underwritten, if you're super healthy or you're young, you've never been to the hospital, you've never been to the doctor, you're in perfect shape, yeah, go fully underwritten. It's probably going to be a better fit. But if you've ever been to the doctor, you've ever been sick, you've ever had to go, if there's anything whatsoever, 9 times out of 10, the excess cost, right, of being a simplified issue product is usually not a huge deterrent for most people that I've talked to, at least. So, but it could be more expensive, to be fair. It definitely could be more expensive than fully underwritten. Number 2, a lot of times there's a limited face amount, so you can't do 5 million, right? Simplified issue. A lot of times the limits range between 250,000 and 500,000, okay? So those are the 2 cons that you have to factor in when you're looking at simplified issue term. Okay, so now we're going to talk about a very, very fun little term product that not very many people know about, and that's return of premium term insurance. And what return of premium, or ROP for short, it just basically means that everything that you've ever paid at the end of the term, you get your money back. Okay, so let's go over some of the pros. So the first thing, as far as the pros for return of premium, is you get all your money back, right? Who doesn't like that? Now you don't have to go your separate way. You go your way, the company goes theirs. It was great peace of mind. It did its job, but you don't get any of your money back. You may have contributed $20,000 potentially over those 30 years or 20 years, however long your term was, and now what? All that money's gone, right? Well, with return of premium, that's not the case. You get every penny back. Number 2, it's a net cost of 0. So the cost of insuring yourself during those critical years, and this is typically for younger folks, okay? Sometimes there are limits on these. We'll go over that in the cons, but a lot of times it goes up to age 50. 50 or below, you can qualify for return of premium most of the time. There are some carriers that maybe go up to 55, but usually it's 50. So the net cost of zero allows you to pay for coverage, pay for insurance during those critical years. Typically, you're working, you're in your building years for your retirement. Maybe you've got kids at home. Maybe your house isn't paid off. There are exposed risks. Well, the net cost of zero allows you to insure yourself, but you get every penny back, which means it doesn't cost you anything to insure you and your loved ones. It is a net cost of zero, which is cool. Number 3, it acts as a savings account or a retirement strategy. We've all heard buy term, invest the difference, right? And I'm a big fan of that, especially if for younger folks. But let's face it, how many of us buy term, right? A staggering amount of people don't have it. And then unfortunately we see it all over GoFundMe and the bake sales and the car washes, and it's brutal. The families that are scrambling for money because a loved one unexpectedly passed away. And I know this because I've gone through it with my family, but that's for another time. But let's face it, how many of us are buying term? And once more, how many of us are investing the difference? If you've bought term or buying term, good on you. But how many of us are investing the difference? See, here's the thing. I remember there was an app. It was similar to like what Acorns is, if you know about Acorns. But it basically would take $50 a week from my personal checking account and put it in this little fund. And it would invest in the stock market. Well, listen, I didn't care about any interest. I just wanted the money to be there growing so that during a rainy day or whatever, I could pull it out and use it for whatever I needed. And I mean, after a couple months, you're looking and they would have the roll-ups on the debit card. So if I use my debit card and I use, as $1.50, well, they'll take the other 50 cents to roll up to $2 and put it in the Acorns account. So $50 a week plus all my roll-ups on my debit card. Well, before you know it, a couple months goes by and I got almost $1,000 in there, right? That's the point, is sometimes if left to our own devices, we don't save. We're not putting money aside. And so this acts as a savings account. So in 20 or 30 years, well, hopefully your mortgage is paid off. Hopefully the kids are out of the house. Now you've got an extra 30, 40, 50 grand potentially. Maybe you're going to buy a duplex, right? And you're going to live on the retirement income from the duplex. Maybe you're going to buy a quadplex. Maybe you're going to invest it into an annuity or whatever. The point is it's a retirement strategy, a simple one for those of us who, let's face it, we're not saving enough, right? This is a great option. Number 4, it often includes living benefits. So if you get sick, you can still use that death benefit on the return of premium term. Number 5, it is simplified issue. There are no paramedical exams. That's very, very nice. You're not having to pass out like me. Number 6, you can convert it to what's called paid up insurance. Now guys, you got to catch this. This is huge. So let's say your annual premium is $1,000 a year. Okay, that's what it costs for this return of premium insurance. It's $1,000 a year. It's a 30-year term. So at the end of 30 years, if you say, I want all my money back, okay, let's say it was a $150,000 term. It was $1,000 a year. At the end of the 30 years, you're like, I want to go my separate way. I want all my money back. The insurance carrier gives you $30,000. Every penny that you've ever paid in, you get it back. You go your way. The company goes theirs. Awesome. But there's more. A lot of carriers, well, not a lot, but some carriers give you the option to convert it at the time of, basically the time that you would cash in on the return, the return of premium insurance. So for example, let's say 30 years down the road, dude, you're killing it. You don't need the money. Your 401k is stacked. You've already got passive income from real estate. You don't need the 30 grand. That insurance carrier gives you an option of converting it to paid up insurance. So rather than getting the 30 grand out, you can convert it to, let's say, 75,000 in insurance. You never have to pay another penny, and it's not a matter of if it pays, it's when. So rather than that company, we'll say Mutual of Omaha, writing you a check for 30 grand, okay, for example, and by the way, anytime I'm using an insurance carrier, this is completely for illustration purposes. I'm not quoting you on Mutual of Omaha. But nonetheless, let's say it's with Mutual of Omaha, which is an unbelievable company. On many of their products, they're a great company. But 30 grand, I said I don't need that. I actually would rather convert it to 75 grand of paid up insurance. So when I die 30 years down the road or 20 years down the road or tomorrow, my loved ones get 75 grand rather than me taking 30 grand today, right? That's the difference. That's a big deal. And you have that option. It's not something that you have to take, but it is a great option, okay? Number 7, there is a fast approval process, which is nice. Number 8, you get to bet on both sides of the risk coin. So you get to live or you get to die, right? That's the coin. Well, with simplified issue term and fully underwritten, you're just betting on dying, right? That's basically what you're betting on. But with this, you get to bet on living because hopefully you're going to live. You're going to outlive that term, right? Most people do. So now you get to bet on both sides and there's a benefit on either one. Those are the pros of return of premium term insurance. And finally, the cons of return of premium insurance are as follows. So number 1, return of premium term insurance can be a little bit more expensive. However, if you look at it going back to our pros list, you're going to get your money back anyway. So it's just basically about your budget. What can you afford? Number 2, they do have limited face amounts. Typically, 300,000 is very common for the limit. If you wanted more, you can. You would just have to combine typically 2 companies in order to get the return of premium. Let's say if you wanted 600,000 or 800,000, but you can do that, which is cool. Number 3, there is no interest returned at the end of the 20 or 30 years. If you did want something like that, you're going to be going with a far more complex vehicle, and a lot of times it's double the cost of this. And so that's mostly for people that are trying to stack away 500,000, or sorry, that's mostly for people that are trying to stack away $500 to $1,000 a month or more in order to get a return on their investment and kind of kill 3 birds with 1 stone. You got the death benefit, you've got the living benefits, but then you also have cash value that you're accumulating that earns percentage. We're not going to go into that. I'm a big fan for simple people. Most people are not that complex. They just want something simple. There is no interest return, but the point is that it did do its job. So if you pass away during those 30 years or those 20 years, well, guess what? Your loved ones would have got the 300 grand, right? But because you didn't pass away, you're going to get every penny that you've ever paid in, let's say 30 grand or whatever it is. So that is nice, but there is no interest return. So just a heads up. Number 4, usually they're 20 or 30-year term products only, okay? You can't do a 10-year or 15-year typically with return of premium. It's usually 20 or 30. Well, listen, I hope you guys enjoyed this video. As always, I'm Andrew Winnett with the Legacy Movement. I'm here to answer all your insurance questions. Feel free to reach out to us, and we will see you on the next video.